If you're actively awarding franchises, I'm sure you've gotten this question all the time from your candidates. It's usually the first question they ask, and that is, how much money can I make being a franchisee within your system? And in the item 19, the financial performance representation, that's where that question gets answered. It's the section that most prospective franchisees and buyers flip to first. That's the area that can dramatically impact your franchise sales, your validation, and ultimately your reputation from day one. So today, we're going to be taking a deep dive into the item 19, what it is, why it matters, what you can say and cannot say, and how to use it as a powerful, trustworthy part of your FDD that shows financial transparency. Before we jump into this video, I want to make sure and share that this is an overview of many of the situations that we've experienced with various franchisors as well as our brand partners. For anything related to your FDD, franchise agreement, operations manual, details around your item 7 and item 19, make sure you consult with a trusted franchise attorney to make sure that you're properly disclosing information with the correct footnotes and explanations. Let's quickly ground ourselves in where this section lives inside the larger FDD or franchise disclosure document. The FDD is the legal foundation of franchising in the United States, sharing proper disclosures with your franchise candidates. It's made up of 23 items that outline everything a potential franchisee needs to understand before they sign a franchise agreement. Things like your fee structures, your leadership team, your territory structure, your financial statements, and the overall operating history of your system. If you haven't watched our in-depth video called What is the FDD, I recommend starting there. Make sure you're caffeinated because it walks through how each of those 23 items fit together and why the FDD exists in the first place. That video will give you the full context that you need to understand where the item 19 sits within the FDD and why it plays such a crucial role in both compliance and franchise development. Now, with that foundation in mind, let's talk about the item 19. Again, this is your financial performance representation, or your FPR. Item 19 is the section of the FDD where a franchisor may choose to disclose financial performance information from the system's performance. It's the only part of the document where you're able to share revenue numbers, margins, cost breakdowns, or any other financial data that helps candidates understand economic performance. And while the item 19 is technically optional, today's franchise buyers, they really expect and look for transparency before making a decision. So a strong, well-structured item 19 gives them clarity about the opportunity and total earnings potential that they'll be able to compare against franchisee validation. A missing or a vague item 19, it does the opposite. Item 19 can include things like average revenue, medians, performance ranges, expense breakdowns, EBITDA, or segmented data across certain franchisee groups, but only if the franchisor has a reasonable basis for the representation and those numbers can be proven through documentation if requested. The item 19 must reflect verifiable reality. This is the section that most buyers flip to first, and it's where their early impressions of your brand begin to form. That's why understanding item 19 and building it the right way is absolutely essential for any franchisor looking to grow with transparency and trust. And a disclaimer here, don't do this on your own. You have to engage with a trusted franchise attorney to make sure you're properly disclosing the information that's shared. A lot of founders look at the item 19 and think, oh, that's where the earnings section is. And yes, it does show financial performance, but that's only a fraction of what the item 19 can really do for you and your franchise system throughout the sales process. Item 19 is one of the most powerful sections in the entire FDD because it sets the tone for how candidates perceive your brand long before they ever talk to you. This is where buyers can get their first impression of whether your model is legitimate, has established proof of concept, can ramp quickly and show long-term earnings and scalability, and whether that's achievable and whether it's something they can see themselves investing in. It also plays a huge role in validation. If the numbers you disclose in the item 19 are not representative of what franchisees are actually experiencing in the real world, everything begins to break down. Validation falls apart, trust disappears, and then when validation collapses, so does franchise development or franchise sales. The item 19 also helps with prospective franchisees, so that way they can start to create the fundamental questions that they want to ask the existing franchisees to understand the earnings potential and the investment opportunity. A clear, well-structured item 19 also speeds up the entirety of the sales process. When candidates understand the economics, conversations move faster, they ask better questions, they're more confident, and the funnel becomes smooth because you're not spending time trying to explain unclear numbers. And finally, a well-structured item 19 that meets all the requirements sets the stage for what your sales team is allowed to discuss with the prospective franchisee. I've said it several times through many of our videos, if it's not in the item 19, it's not in your director's mouth. This is setting the boundaries for what can and cannot be discussed from a financial perspective. So bottom line, if you want to be able to talk about certain financial metrics, those metrics need to be disclosed in your item 19. So the item 19 is not about selling the opportunity, it's about setting the right expectations from the very beginning and building the trust that drives long-term franchise success. Now, item 19 does give you some freedom in what you can disclose, but it's not unlimited freedom. There are very clear rules about what must be included if you choose to make an item 19 FPR, and the entire goal is to make sure the information is reasonable, accurate, transparent, and grounded in reality. Anything you put in the item 19 has to be backed by reasonable data, real documentation, and clear explanations. No hypotheticals, no best case scenarios, and definitely no promises about what future franchisees will earn. What you can talk about is exclusively historical, reported and recorded performance. You can share historical numbers from franchisees from company-owned units or from a specific subset of units as long as you clearly define the subset and the specific characteristics that the units in the subset share. You can also disclose cost structures or margins, again, as long as that data is reasonable and supported. What you cannot do is make forward-looking statements. You can't say things like, franchisees will earn, or you should expect. None of that belongs in the item 19, and none of it is allowed outside of the item 19 either. It is only allowed by the franchisees to talk about things not listed or disclosed in the item 19. If it sounds like a guarantee or a promise, it's off limits. The rule is simple. If you have a reasonable basis with recorded data for the representation and meet any other requirements based off of the type of disclosure you choose to make, you can include it in your item 19. Now let's talk about some common styles or reporting that we see in the item 19, because not every brand should disclose the same type of financial data depending on your system. The right approach depends on your business model, your system's maturity, and how much clean, consistent, and reliable data you actually have and are getting from your franchisees. Of course, a best practice on an annual basis is to have a standardized set of reporting data that you are collecting from your franchisees, so that way you can update your item 19 with refiling each year. In franchising, there are 3 common item 19 structures, and each one serves a different purpose. The first being a basic revenue table. This is the simplest version of an item 19 and most common with emerging franchisor brands. This usually includes high-level numbers like total system revenue, median revenue, sometimes you have ranges, typically no expenses, no margins, just top-line clean data. This approach is best for young brands with only a few franchises, service concepts where expenses can vary widely, seasonal businesses or models with inconsistent early data, or founders that are still tightening operations before showing deeper economics or full P&Ls. The basic revenue table delivers clarity without overextending. The second one is an operational breakdown. In an operational item 19, this is where more established brands really shine. This version typically goes much deeper than just top-line revenue. It shows more of a true profit and loss scenario such as revenue, cost of goods or COGS, labor, operating expenses, and net operating income or EBITDA. This style is giving candidates a true picture of the business model. It works best for systems that require their franchises to keep a consistent chart of accounts and require regular financial reporting. This approach is best for retail or restaurant concepts with predictable cost structures, brands with strong operational consistency across their locations, franchisors that want to demonstrate and showcase healthy margins, or systems with enough data to show averages that won't mislead candidates. Operational item 19s build trust very quickly because they show a massive amount of transparency from day one. But you have to be confident in your economics and consistent across all of your locations within your system. A third example is the multi-tier performance model. And this is the advanced version of reporting. This is where you break performance into groups. Usually it's the top third, middle third, and bottom third of your system with high, average, median, and low performance tables depending on the KPIs collected, with some brands even using quartiles. This structure shows candidates the distribution of performance instead of a single average. It's honest, realistic, and it's incredibly useful. This style is great for larger, mature systems with enough units to create meaningful tiers, businesses with wide performance variability, concepts where operator skill may impact results like fitness, education, or home services, and franchisors that want to show both potential and realism. Multi-tier models help avoid unrealistic expectations because candidates can see how performance spreads across the entirety of the system. So which one should you choose? The best item 19 is the one that matches your brand's maturity and shares the data that you have to date. It's not always the one that looks the flashiest. If you have a big established system with clear performance and a bell curve, you may want to consider a multi-tier model that gives buyers the transparency they expect. But the rule is simple. Your item 19 should always be reasonable, transparent, realistic, and proportional to where your brand is today. That is how you build trust, and that is how you set proper expectations from the very start. Again, regardless of these common situations, I want to re-stress the importance of working with your bookkeeper, CPA, and franchise attorney to identify what kind of reporting works best for your system based off of your franchisor lifecycle. Now, how does the item 19 impact franchise sales? When it comes to development, the item 19 is one of the biggest levers you have because a strong, well-structured item 19 immediately builds confidence in your business model. When buyers see clear numbers, they feel like they finally understand the opportunity and they understand the risk. What's the best that can happen, but what's the worst that can happen? They understand the potential and they understand the real economics behind the model. And here's what we see every single day when we work with brands in the FastLane. If the item 19 is clear, validation is smoother. If validation is smooth, candidates move faster. And when candidates move faster, conversions go up. It's that simple and it's that powerful. The brands that scale well, the awardable brands, all of them have item 19s that are reasonable, data-backed, easy to understand, and aligned with what franchisees actually experience and are going to validate with new candidates in the process, because that's what builds trust. That's what tells candidates this is a real business with real economics and real results behind proof of concept. So item 19 isn't just the earnings section, it's a trust-building mechanism, and when you get it right, it accelerates your entire development process. So for some final thoughts, your item 19 is one of the most important parts of your entire FDD. It's where transparency meets strategy, it's where candidates start forming their first impressions of your brand and building their first questions, and it's where trust is either built or lost. The brands that scale the right way use the item 19 to create clarity, not hype. And if you want your item 19 and the rest of your FDD to be strategic, aligned, and built for growth, that's exactly what we help brands navigate every single day. Now, if you found this breakdown helpful, check out the other videos on our channel. We cover everything from franchising fundamentals to growth strategy and franchise recruitment. And if you're thinking about franchising your business, reach out. We'd love to talk with you and help you scale the right way right away.